Investing without analyzing a company is like buying a house without ever stepping inside. You might get lucky, or you might wake up to a leak. Today I'll teach you a repeatable, practical process to analyze any company before you invest. The business, the numbers, the people, the price, and the red flags. There are two ways people analyze stocks: technical and fundamental. Technical is price and momentum, useful for timing. Fundamental analysis asks, what is this business? How does it make money? Is management good? Are the finances healthy? And is the price fair? We'll focus on fundamentals, because if the business is good and the price is reasonable, time works for you. Start with the simplest question. What does the company actually do? Read the first page of the annual report and the business overview section, not the PR fluff, the facts. What products or services generate revenue? Who are the customers? B2B or B2C? Large clients or many small users? Is the company cyclical? Example construction, steel, or defensive? Example consumer staples. Next, does it have a moat, a sustainable advantage? That could be strong brand, network effects, patents, cost advantage, distribution reach, or regulatory protection. A moat is what lets returns stay high longer than competitive noise. A good company in a terrible industry is still risky. So study the industry, growth trends, cyclicality, regulations, raw material risks, and entry barriers. Who are the competitors? Is market share concentrated or fragmented? Also look at substitutes, e.g. ride-hailing replace some taxi demand. Use trade reports, industry sections in annual reports, and regulatory filings. Now the math. Financial statements tell the true story, if you know where to look. Focus on 3 documents: income statement, balance sheet, and cash flow statement. Income statement shows sales, margins, and profit. Track top-line growth and gross/operating/net margins over 3 to 5 years. Are margins stable, expanding, or collapsing? Balance sheet, assets, liabilities, and shareholders' equity. Is debt rising faster than profits? Are receivables ballooning? Check current ratio and capital structure. Cash flow statement. Operating cash flow is the heartbeat. A profitable company that can't convert profit into cash is dangerous. Look for consistent positive cash from operations and free cash flow after capex. Always analyze trends over multiple years to avoid one-off distortions. Ratios distill numbers into signals. Here are the essentials. Profitability. The gross margin equals revenue minus cost of goods sold, divided by revenue, how efficiently the company produces. Operating margin equals operating income divided by revenue, how well it controls operating costs. A return on equity, ROE, equals net income divided by shareholders' equity, how effectively management uses equity to earn profit. High ROE sustainably is attractive. Efficiency quality. Asset turnover equals revenue divided by total assets, how well assets generate sales. A receivables days equals accounts receivable divided by revenue, times 365, long or rising receivable days are a red flag. Leverage solvency. Debt equity equals total debt divided by shareholders' equity, how leveraged the company is. Interest coverage equals EBIT divided by interest expense. Lower coverage means risk if rates rise. Cash and valuation. Operating cash flow/net income should ideally be equal to or greater than 1 over cycles. Free cash flow equals operating cash flow minus capital expenditure. True cash available to shareholders. Earnings per share EPS, and price to earnings PE ratio for valuation. Ratios are signals, not absolutes. Always compare with industry peers and historical numbers. Valuation methods. Understanding a company's value is how you avoid paying too much. There are 3 practical methods. Discounted cash flow, DCF, project free cash flows for 5 to 10 years. Discount them to present value using a required rate of return, WACC. DCF is powerful but sensitive to assumptions. Small changes in growth or discount rate change value a lot. Comparable multiples. Compare the company's P/E/EV/EBITDA P/B with peer companies. If it trades at a big premium with no clear reason, ask why. Dividend discount model, DDM. For mature dividend-paying companies, value the company as the present value of expected dividends. Use multiple methods and look for convergence. Add a margin of safety, don't pay fair value, pay below it. Numbers lie. Management matters. Check. Founder/CEO track record and integrity. Look for long tenures and proven capital allocation. Related party transactions, excessive payments to insiders are a red flag. The promoter shareholding trends, are promoters selling large chunks? Auditor issues qualification notes in audit reports. The promoter pledging of shares, a big red flag. Sudden changes in accounting policies that inflate profits. Read shareholder letters, investor presentations, and independent corporate governance reports. Here's your decision checklist, a repeatable process. Business clarity moat, industry attractive, revenue margin trends positive, strong cash flow reasonable capex, debt manageable, interest coverage good, management credible incentives aligned, valuation reasonable with a margin of safety? If most answers are yes, you can consider investing. If several are no, either stay away or wait for better price/visibility.